Good afternoon and welcome to CMC Markets and this Monday market webinar on the 23rd of January. Before we get underway, I have to get a couple of housekeeping rules out of the way. The obligatory risk warning. Hoping you can all hear me loud and clear and you can see the screen. I did a few tests in the lead up, so hoping that any latecomers can hear me. Once we get the risk warnings out of the way, we can move on and look at the various markets that I'm particularly interested in this morning and this week, because I think last week I think markets were very much on tenterhooks as to what Donald Trump would say at his inauguration speech on Friday, and certainly I think that's been reflected in the behaviour of stock markets thus far this year. It's been rather schizophrenic in nature. We've seen record highs for the FTSE 100, up around 7,300, but since then we've come off quite considerably. European markets, on the other hand, have been pretty boring. They've been pretty mundane. US markets also appear to be stuck in the mud near record highs. So what to make thus far of Mr. Trump's inauguration speech? Well, certainly it's garnered an awful lot of attention for being very introspective and protectionist. I think there was some expectation that Mr. Trump would tone down his rhetoric once he got his hands on the levers of power. That doesn't appear to be the case, and I think there could be some disappointment being reflected. Certainly in the currency market, we've seen a sell-off in the US dollar, but we've seen a weaker dollar for quite some time over the course of the past few days and weeks. The dollar index has been on a slow slide lower over the course of the past 2 to 3 weeks. In any case, and that's very well reflected, I think, in the behaviour of the dollar index, which we can see on my Bloomberg chart here, which I'm just about to bring up to give you an indication, because we've got slightly more history on that, and I think it bears it out. It bears it out quite nicely. Looking at that, there does appear to be some evidence that we're in the process of potentially rolling over on the dollar index, and I think that does have implications for the major currency pairs as well. I think if that rollover continues, then ultimately we could see a higher euro, we could see a higher cable, and we could see a lower dollar yen. And certainly some of the price patterns that I've been keeping an eye on over the course of the past few days and weeks would appear to suggest that potentially we could well have seen the bottom in the cable, bottom in the pound, and that in itself has implications as well for the FTSE 100, which has pushed to record highs over the course of the past couple of weeks since we broke above those previous record highs at 71.20. So when I look at the dollar index, keep an eye on that 100 level, because I think that could be particularly important in the context of further gains for euro dollar, further gains for cable, and further losses for dollar yen. Now, earlier this morning I posted a note which I tweeted out. It's on the website, and talking about the correlation between the UK 100, the FTSE 100, and the pound against the dollar. And I talked about, and this is one of my favourite indicators, it's the engulfing candles, or the key reversal day, bullish and bearish engulfing candles. So I'm going to start here, because ultimately I think this is it's been one of the key movers thus far this year. It's been the FTSE 100. Now, since we broke above the October lows at the end of last year, we've pretty much gone one way within the UK 100, the FTSE 100. We peaked just above 7,300. Since then, we've slowly slipped lower. Now, if we change that to a weekly chart, that gives us a much better idea of what the key levels are on the FTSE 100. And for me, it's the key support, which is basically where we've bounced off today, is 71.20. It was also the previous peaks here in 2015. It was the peaks in 2016 before we broke through it at the end of last year, the beginning of this year. Now, this candle here is the one that's really drawing my attention. It's a key day reversal because we've made a new high, or we've opened near the highs, but when we've closed lower. So it's this particular area here. Now that on its own isn't enough to make me overly bearish on the FTSE. But what has piqued my attention, and I think this is particularly important, is what's driven this rebound or this rally in the FTSE 100 over the course of the past few weeks. It's been the decline in the pound. So what we're looking for here is evidence that the pound has either got further to fall, or it's starting to carve out a base and potentially looking to rally. Now if the pound starts to rally, that's going to limit the upside, or any further upside, for the FTSE 100. So on that basis, I'm a little bit cautious about being overly aggressively long the FTSE 100. Having said that, as long as we hold above 71.20, then the prospect for a short squeeze back to 7,200, 7,250 is very much on the table. But the oscillator is starting to look overbought. We've posted a key reversal on the FTSE 100. So now what I'm going to be looking for is some form of, not confirmation, but further evidence that potentially we could see a little bit of a weakening in the FTSE 100. So let's go over to the cable, because that is equally as important in the context of where we go to next. Now this is a daily chart, this is a daily candle chart, and obviously this is the very sharp rebound that we saw on Monday and Tuesday of last week. The Brexit rebound, Theresa May's speech, her confirmation that the UK is going to come out of the single market, and potentially the customs union as well. We've also broken above this series of highs through here. We've broken above the 50-day moving average, which has acted as resistance and support in equal measure over the course of the past 2 to 3 months. Now as long as we hold above this 50-day moving average and stay above this series of lows here, see these 3 days here, 1, 2, 3, that there is going to be a key area of support. If we're not able to sustain this move higher, that level is around about 122.5. So you've got 3 successive days where the pound's held above 122.5. We've now come higher in the early part of Monday. We need to sustain that move higher. Further evidence, if some were needed, is this candlestick here. We posted a key day reversal on cable. We opened lower. We haven't been able to push lower, sustain those moves through 119.80. So there's a potential double support there, with a potential double bottom, with a top at 127.95. So for me, that suggests that if we can break this move higher through 124.40, then potentially we can go all the way back to 128 on the pound against the dollar. If we go back to 128 on the pound against the dollar, then I think that will potentially put further pressure on the FTSE 100, push it below that 71.20 level and push it down towards 7,000. So what we've got here is we've got key weekly reversals on the FTSE 100, which is potentially bearish. We've got a key weekly reversal on the cable, which is potentially bullish, which indicates that either we're going to get further dollar weakness, or we're going to get further sterling strength, or a combination of the two. Now we've got the Supreme Court ruling tomorrow, 24th of January, on whether Theresa May can unilaterally trigger Article 50 to begin the process of exiting the EU. Now in December, MPs debated that particular course of action, and irrespective of tomorrow's outcome, while it could introduce an element of volatility to the exchange rate, I don't think tomorrow's ruling will slow down the potential for the triggering of Article 50 by the end of March. If the court ruling insists that ultimately Parliament has the final say in terms of whether Article 50 gets triggered, then what will happen is that the government will bring forward a bill to rubber stamp that very process. And given some of the mood music coming out of Westminster, then ultimately I think there will be a majority in the Commons to push that through. Yes, there may be some dissent in Conservative and Labour ranks, but ultimately I think that will go through. I don't think it will introduce that much in the way of volatility. in the pound against the dollar. We may see a dip back to 122.5, and that will be the only reason I would revise my slightly bullish outcome for the pound against the dollar, is if we go back below 122.5. I'm not of the opinion that that is likely to happen, but as with anything with currency markets and financial markets, never say never, because we've found out to our cost that over the course of the past 12 months that the consensus view isn't always the right view. Certainly no one expected Brexit and no one expected Donald Trump, and we're faced with both prospects as we speak, and certainly we're only in the third day of a Trump presidency, not taking bets on how long he'll survive, but certainly I think you've got to base your analysis on the prospect that he probably will be able to survive 4 years. Even if he doesn't, you've got to basically work on the basis of the facts at hand, and at the moment this price action is telling me that the market is potentially short of sterling, and the sensible trade would be for the moment to keep your shorts quite small, because the potential for a short squeeze is quite high given where we've come from and historically how the pound has reacted in the past. In 1992, Black Wednesday, the pound dropped quite sharply from September 1992, and it bottomed out in around about January or February the following year. It was a similar sort of thing in 2008 as well. We had a sharp fall in the autumn, but the pound bottomed out in and around the beginning of winter and the beginning of spring the following year. So on a seasonal basis, after sharp declines, the pound does have a tendency to find a little bit of a floor as we come into the beginning of a new year. So that's very, very important to bear in mind, given the fact that we were unable to take out that 119.80 level. So I think the rebound that we've seen in the dollar thus far this year could find it difficult to sustain, given the fact that Mr. Trump has already announced that he's going to looking to renegotiate the North American Free Trade Agreement. He's withdrawing from the Trans-Pacific Partnership. They're the first policy pronouncements of quite a number of policy pronouncements that we could find coming out into the headlines over the course of the next few weeks, and that uncertainty, I think, has the potential to weigh on the dollar. Now obviously the Mr. Trump is running up against the Federal Reserve is due to meet on the 1st of February next week for the second FOMC meeting, I think, of actually the first FOMC meeting of 2017, in the aftermath of its December rate rise. And we've certainly heard an awful lot of chatter from various Fed policymakers over the course of the past couple of weeks that leads us to believe that potentially we could see 3 rate rises this year. Now that may well happen, but I think it's unlikely to happen any time in the first quarter of 2017 because of the uncertainty surrounding what Mr. Trump might do in terms of policy over the course of the next few weeks. So certainly I think there is no press conference for the Fed meeting, the first Fed meeting of this year, so ultimately we'll have to make do with the statement. Certainly some of the comments from Patrick Harker that we heard late on Friday night would appear to suggest that there's no rush to raise rates at this point in time, or raise rates further at this point in time. So certainly I think we're not going to get anything before March, and ultimately we will then be data dependent, and really then becomes a matter of what Mr. Trump does with Barack Obama's legacy. And we'll find out what his legacy will be when we get the first iteration of US fourth quarter GDP on Friday this week. That's expected to show a minor slowdown from the 3.5% annualized number that we saw for Q3. That's expected to come in at 2.